We've been focusing more on treasuries lately because we're witnessing rare occurrences not seen in decades where you can genuinely obtain a yield over a significant period, like 10 to 15 years. That's a fairly acceptable yield. Hence, this leads us nicely to our next major prediction for 2024. Let's delve into the bond markets. How do bond markets fare in contrast to stocks amidst all the ongoing developments and events?
Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the US Treasury bond market, the short-term treasuries, 4-month bills, 6-month bills up to 1 year, from 0 to 1 year. They're called bills from 2 years to 20 years. They're called notes, and the 30 years called a bond. So if you're an expert, you say bills, notes, and bonds, but they're all treasury securities. I just want to be specific. We're not talking about corporate bonds, just to be clear, because those may do very poorly. If a company is going to underperform, we're going to go into recession. You're going to see bankruptcies increase. Those corporate bonds are going to get hammered, but certainly junk bonds. So we're talking about US Treasuries. The funny thing now is that the highest yields in the US Treasury market are in like a 6-month bill. Like, wait a second. Shouldn't I get more if I buy a 30-year bond? Or shouldn't I get more if I buy a 10-year note? It's a longer maturity. More stuff can happen. Inflation, credit downgrades in the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It kind of goes. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. Maturities are right around 6-month bills. Bills going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield of maturity than you do on a 2-year note. So the interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways and a higher interest rate. So it's like I say, the best of both worlds, but the highest interest rate is actually from 6 months to 1 year. So those are very safe securities. And they're paying like 5.25%. Not quite 5.5%, but between 5.25% and 5.5% for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, oh, yeah, Jim, that sounds good. If interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down. If interest rates go up, that's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people. But that's just how it works. So yeah, buy a 2-year note that yields about 5.1%. Very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it. Because if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note because a longer maturity has a higher. Not to get too technical, it's called DBO $1 value. 1 basis point. What it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points, or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is, the longer the maturity, the more they go up, they're more volatile. And so to your notes, a really attractive piece of paper, very safe. It gets your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown. We're looking at all kinds of geopolitical risk. Stocks are coming down, then interest rates are going to come down too. Again, 10-year note is riskier from a market point of view, not risky from a credit point of view, good yield, and a lot of capital gains potential. If you have a slightly lower risk appetite, but you want the same basic kind of trade, have a look at the 2-year note. 5% yield, guaranteed principal, and IV rates are not going up. If rates come down, you'll have a little capital gain on that as well. So those are the sweet spots. If you're really conservative, buy the 6-month bill. You get 5.25% close to it, and it matures in 6 months, and there's almost no credit risk or market risk at all.